Welcome, everyone, and thank you for joining us here today. I'm thrilled to have John Versace, a senior planner with Apt Wealth Partners in Melbourne, Australia, joining me here to talk about outbound Australian financial planning for tax effectiveness. My name's Ashley Murphy. I'm the founder and principal of Arete Wealth Strategists. And I just wanted to begin today's presentation with a disclosure. Please keep in mind, this is general advice. This is not specific to you. You would be well advised to go and speak with a qualified cross-border financial planner or accountant or tax attorney, whatever the case may be pertinent to your situation. And I know John has his own general advice warning.
Yeah, so for us, it's this is all general information. We haven't had the time taken the opportunity to assess your personal circumstances. So do reach out and speak to a professional like Ashley or myself or someone else and receive personal advice if that's what you're looking for.
And I just wanted to mention about our YouTube channel. So we have several dozen, I believe there's about 40 or so different topics that are up there that have been posted over the years. Please feel free to have a look at that. And I also wanted to mention that last month's presentation, where we did a deep dive case study in cross-border stock awards and how that taxation works, that is now up as well. If you register for the presentation, you will be notified of when a presentation hits YouTube. It's been our observation that only about 35 to 45% of registrants actually show up for the live webinar. So a lot of people just register in order to be notified of when it hits YouTube. Here's a little bit about me.
Yep, so I'll take you through a little bit about Ashley. So Ashley is the founder of Arete Wealth Specialists. So that is a US domiciled firm that focuses on looking after Aussies with their US financial advice obligations. A very unique firm, Ash, in that I don't believe there's another one out there that does focus on Aussies living in the US on the US side of things. So that was founded in 2013 and has had exponential growth in the last few years. And Ashley's also the founder of the International and Cross-Border Knowledge Circle, and now I forget the title of the program that you started for international financial advisors, Ashley.
The masterclass in international and cross-border financial planning, which is really for financial advisors. Yeah,
that's the one. Yeah, so Ashley is a wealth of knowledge on the cross-border space, but in particular for Australian US residents.
And my colleague here, John Versace, he's been in the financial services over 15 years. And in Australia, I think we have, as per Morningstar, actually, this is from their biennial report, the Global Fund Investor Experience Study, and I've done a presentation on that about a year ago, speaking on that very topic. Australia has the best environment for financial services distribution, which means the most pro-consumer friendly environment. And I think John is a testimony to that when we look at his experience in being a financial planner. So Bachelor of Business in Economics and Finance, Advanced Diploma of Financial Planning, CFP, head of Apt Wealth Partners, dedicated expat services team, really with a focus on the US. So John really goes deep on the US side of things. And his firm has been awarded all manner of different awards and is recognized annually by some of the most prestigious Australian publications. So it comes up every now and again how John and I know each other and how we work together. And it's really as simple as this. So I'm registered in the US, John is registered in Australia. If I have a client who is moving to Australia, lock, stock and barrel, and they have very little to do with the US, I say, at this point, I think you should talk to John. And at some point, and we just had we just had a client recently who moved back to the US, completely finishing her affairs in the US. And I've said the appropriate thing to do here is to simply make an introduction to John. I think he's going to be your best source of advice going forward, because she really has nothing to do with the US anymore. And vice versa. John, maybe you have a description of the same thing.
Yeah, absolutely. It's I think it really depends on where the assets are going to be situated, and that's the key point. If the main assets are going to be situated in the US and it's a long-term move to the US, then Ashley, you'll be the appropriate person. If individuals are looking to move to Australia and their main life and assets are going to be domiciled in Australia, then Apt Wealth and myself might be the most appropriate person. And sometimes it is a bit of both. There's assets in the US and Australia, and Ashley and I work together on a number of clients in servicing both the US and Australian, and collaborating together so that there's a holistic approach to the cross-border financial affairs, which works really well in those circumstances. But it'll either be Ashley or myself or both, essentially.
And it's worth mentioning that we have a commission-free, a royalty-free, there's no form of compensation passed whatsoever between Arete and Apt. It's simply, we found who we believe to be the best service provider given a client situation, and that's it. So it's really in our client's best interest. So the kinds of issues we work with our clients on include, say, Aussie business owners living in the US, high net worth family currently living in the US, or an Australian executive permanently relocating to the US, or indeed, if I had space on this table, I would add also some Australians with significant US investments and need for cross-border financial planning and tax advice. So moving into the outline for today's presentation. Firstly, John will be going through talking about what to know about this term, taxable Australian property. I've included maybe a little bit, it's a little bit cheeky, but it's Australia's exit tax. They don't call it that, but it really functions in a similar way to that, a deemed disposition at the time of departure. Next, John's going to be going through and giving an introduction to the non-resident tax rate and implications for Australian taxation, taxable property, assets held in Australian family trust while overseas. Just talking about this morning, we had Melvin Warshaw, who's a tax attorney I work with in the United States, talking about this very issue. What's often very good and sound financial planning advice can come undone when someone moves overseas and they continue to hold assets in their Australian family trust. The US can take a dim view of that situation. So thank you, John, for talking about that. What to do with your self-managed super fund at departure. I'll come in towards the end to talk about immigration status, choice, and effect of moving on to a green card, and then restructuring your portfolio for US tax compliance and effectiveness for the individual moving to the US. All right, so I'll hand it over to John at this point.
Yeah, thanks for that, Ash. And I guess, we wanted to start with a very high level, snapshot of the things that you think you should be thinking about as you move over to the US. So the first thing we'll note is that you should start the planning process as soon as you possibly can. Finances, with all the things you've got to think about as you're moving over to overseas or moving from Australia to the US, finances can be neglected a little bit, but it's super important as early as you possibly can to start planning. It's never too early to start your planning of how you should be structuring your financial move. Some of the things that we'll talk about today, if you're already in the US and starting the planning process, it's too late to navigate some of the issues. So, the earlier you can start, the better equipped you'll be to navigate some of the considerations and issues that you'll face as you transition to the US. It's really important really periodically and on a regular basis to reassess your financial goals. And in particular, whenever there is a life event that has happened in your circumstances, and moving overseas definitely constitutes a life event. So you want to make sure that you're taking stock of your situation and reassessing your financial goals as you transition over to the US. And it will give you a lot of clarity on what financial decisions you should be making. So often we get people saying we don't know what we should be doing, but if you reassess your financial goals, ultimately, if you base all your financial decisions on what is going to be the best thing to get me towards my financial goals, you will have a lot more clarity and a lot more focus on the things you should be doing with your finances. So Next point there is to consider your length of stay in the US. Now, sometimes this isn't easy to do, and we've got many clients that just don't know how long they're going to be in the US or whether they're actually going to return to Australia. But as much as possible, if you have a general time frame of how long you're going to be in the US and when or if you expect to return to Australia, it will then help you plan your next moves in terms of your finances. So for example, if you're planning a 12 or 24 month stay in the US and then come back to Australia, probably wouldn't make much sense for you to be selling up your assets and sending them all across to the US. But if you're looking at a 10 plus year stay, or maybe a little bit less than that, a little bit more than that, then you potentially would be looking at sending assets across to the US. We've got a fire drill happening in the office right now, just right on time, but please bear with us as we go through that. Hopefully that'll stop in a second. All right, I think hopefully we're good. So understand your US tax treatment of your assets and structures. So the way the US will treat certain assets and structures outside of the US that are domiciled outside of the US can be quite onerous, and we'll go into that a little bit later on in the webinar. So you need to really understand, what or how the US will treat those assets. Some very, very common Australian financial planning strategies and structures can end up, really complicating your US tax and costing you, a lot in US tax. So, really understanding how the US will treat all your assets is really important. Determining your Australian tax residency is important as well. Not as clear cut, unfortunately, as it is with other countries to determine tax residency. I'll talk about that in a second. But that will then have a really important implication of how Australia will tax your income and assets. So, if you become a non-resident for Australian tax purposes, the rate of tax that you're taxed on anything that is taxable in Australia will change, and also what is taxed will change as well. So you really need to take stock of that and understand that to prepare your financial moves. Really important point there on our slide is that you need to determine what to do with your assets. And really what you'll need to think about as part of that is a lot of the things I've already mentioned on that slide there. How long you're going to be in the US, what are your financial goals, and are the assets that you've got at the moment appropriate for your financial goals? US and Australian taxes, and your new tax position as you move to the US, how are they affected by, or what rate of tax are you going to be paying on the income and capital gains that you accumulate whilst you're in the US? And we'll talk a bit about that today. The last point there is prepare a financial strategy for your move to the US. And, this is really important at all times, but what we find is that many people that are going to the US are going, for various reasons, but it is often because of a work opportunity. That's very common for someone moving from Australia to the US. The US is the land of opportunity. There's amazing opportunities in the US, and often, the talent from Australia is significantly rewarded. But you've got to make sure that you then make the most of what you earn in the US and have a strategy around that. Considering all these things that we're talking about. And we do find that, people might just have money just going into the bank and just, accumulating in their bank account, or they're making poor financial decisions without sort of contemplating all these different repercussions. So it's really important to just make a plan for your future and set yourself up for your future goals. So moving on to Australian tax residency, this is one of the first things you should contemplate. What will be your Australian tax residency status? Will you be a resident or non-resident for Australian taxes? And unfortunately, it is a little bit convoluted to determine your Australian tax residency, but the way it sits at the moment is that there's 4 tests to determine your tax residency. So the first 2 tests there on your screen are probably the most important ones and the most common ones. the resides test. So, you know, where is your physical presence? You know, are you physically present in Australia or overseas? What is your, you know, where is your family based? Where are your assets? Where is, you know, your family? So all the things I've basically, where are you building your life? Will satisfy that resides test. Is it in Australia or overseas? And the second point there is the domicile test. So where is your permanent place of abode? Where do you call home? Not necessarily the property itself. You know, if you own a primary residence in Australia and move out and move overseas, they're not talking about that. Where do you call home, make dinner at night? That's where the domicile test comes in. So it's a bit subjective, unfortunately, and there's not a sort of hard and fast rule on this. A lot of the determination around Australian tax residency has been done through the courts and case law. By and large, if you're spending, you know, if you're intending to go overseas for, you know, 2 or more years, it's, you know, more probable than not that you'll be a non-resident for Australian tax purposes. If you're going for 6 months, you know, most likely not. And I guess that the thing is to really get some accounting advice and get some advice from someone that really understands the tax residency laws. How does that then impact your taxes? So this next slide is going through the tax rates for a resident versus a non-resident. So in the middle of your screen there, the middle column in your screen there is how you're taxed as a resident. And as a resident for Australian taxes, you get a tax-free threshold of $18,200 on the first $18,200 that you earn each year. There's no tax, and then, you know, the more you earn, the tax rates progressively increase from there. On the right-hand side of your screen, you'll see the tax rates for a non-resident. And the thing you'll note is that there's no tax-free threshold. So from the first dollar you earn that is assessable by the ATO as a non-resident for all Australian taxes, you're taxed at 32.5%. So it is a higher tax rate for non-residents on the income that you're paying in Australia. The good news is that what is actually taxed as a non-resident for Australia is much more limited. The only thing that is taxed typically is taxable Australian property. So that's a real key point, is that you will only be taxed on your taxable Australian property. Now you'll need to file an Australian return if you're a non-resident for Australian tax purposes, if you have taxable Australian property, or if you have a HECS or HELP debt as you leave Australia. Many of you have been through tertiary education, have accumulated you know, a HELP debt, and it is important to make sure that you do keep filing, because you are still needing to repay that if you do leave Australia, something that some people miss. So on the next slide, we'll delve into a bit more about what taxable Australian property is and how it is taxed. And it's some really important points as you leave Australia, and also as you accumulate wealth overseas, on how you're taxed. So what is taxable Australian property? Very simply, it is, as you would guess, it's taxable, you know, it's property in Australia. So commercial or residential property, any land or any indirect interests in property. So through property trusts or REITs as they're known in Australia, they will be taxed continuously by the Australian government. The Australian government saying, this is our land, it's growing in value, you're getting a return on it, we're going to tax that. Now, the way the ongoing tax is, so there's no exit tax as you leave Australia on taxable Australian property. But the way the Australian government will tax that is that, as I say, any income you earn through rental income, you still need to file a return each year, and you get to offset all the usual things that you offset on your rental income, like rates and interest repayments and all the like. But you still need to file a return in Australia. The big thing that we'll talk about is that you don't get a 50% discount on the capital gains for the period of time that you're a non-resident for Australian tax. Now that's a key point. So usually when you're a tax resident of Australia, when you eventually go to sell the asset, you get a 50% discount on the capital gain. And I'll show you a worked example a bit later on. But when you're a non-resident, or for the period of time that you're a non-resident, the accumulated capital gain, you do not get a 50% discount. And it can be quite dramatic in terms of the tax you'll pay, especially if you're spending long periods overseas. Now, what is not taxable Australian property is really everything else. So I guess the main examples would be shares, managed funds, or anything that's not taxable Australian property. Now, significant thing that you need to think about as you move overseas and become a non-resident for Australian tax is that the Australian government will look at any accumulated gains that you've made from any asset that isn't taxable Australian property, like your share portfolio or managed funds, and essentially deem that you've disposed of those assets when you leave Australia. So it's pretty significant. And as Ashley's titled there, it's unofficially Australia's exit tax, in that Australia is saying, you've made that taxable gain, whilst you've been in Australia. We want to tax you as you're leaving Australia, even if you haven't physically sold the asset. So you still hold the asset, and basically they're saying, okay, we're going to assume that you've actually sold that. The problem with that is, for a lot of people, is that usually when you pay capital gains tax, you've actually sold the asset, and you've actually got the capital proceeds. So you've usually got cash sitting there that you can then pay the tax. So think of it, you sell a property or a share portfolio when you're in Australia, you sell that, and then you've got the cash sitting there. You're going to have to pay some tax, and you've got the cash to do that. You factor that into your future planning. But if you're still holding on to a share portfolio and you leave Australia, you may not, depending on your other circumstances, you may not have the assets to actually pay for that. So there's a bit of planning involved there. The trade-off is that when you're a non-resident for Australian tax purposes, Australia will not want to know not want to tax you on any gains whilst you're a non-resident for Australian tax purposes, for any gains that you make on your shares or managed fund portfolio. So you pay that, essentially the exit tax. You go overseas, and then essentially you won't have to worry about paying any more capital gains tax for anything you sell whilst you're overseas to the ATO. Now, for those that are planning on coming back to Australia, in the eyes of the ATO, they will look at the day that you return to Australia and say, okay, we're deeming that you've purchased these assets today. Just bear with me one moment as we get through this fire drill, but I'll just be 1 second. Shouldn't be too long. It's always the way, isn't it, Ash?
I'm expecting the construction to start just outside any moment now, because they got wind that we're presenting right now.
Pretty certain it is a drill, so we won't be evacuating. Once that stops, we'll just have a little intermission. I think it works.
Yeah. Okay. John, we can actually hear you okay if you want to proceed.
So I guess the next thing to on this slide, we've already covered those initial comments about the type of asset, taxable Australian property, and essentially the big thing in terms of the ongoing tax is that taxable Australian property is taxed at Australian non-resident tax rates. For any dividends with Australian shares, you pay withholdings tax. So there's a withholdings tax that you pay, which is between 10 to 30% on your shares and managed funds. So just moving on to the next slide. and a lot of this we've already covered already, but we'll probably move in. I guess the big point on this slide is that for taxable Australian property, there is no 50% discount on the capital gains when you're a non-resident for Australian taxes. So that is a key point. Can you guys still hear me okay?
Yeah, you can still hear you okay, but I could make a point here for a minute, John, if you don't mind me putting you on mute. Okay, so this actually comes back to a point I've been making for a long time now about why I'm so bearish, and I'd love to hear your opinion on this, John. You might have a different opinion, and intelligent people can disagree, but I just don't think it's a great idea to hold investment property, Australian investment property from abroad. And here are some of the reasons why. So your rental income is taxed at those non-resident rates. Let's go back to that for a second. So it's getting taxed at 32.5% from the very first dollar. You also don't have the capital gains rate exemption. So you're paying your marginal rate, essentially, on whatever capital gains you have. So losses can be carried forward to future years. I just mentioned that a minute ago. US assesses worldwide income capital gains. Any Australian taxes already paid can be offset on US tax returns. So that's your foreign tax credit right there. John, I'll just pass it back to you there and move to the next slide for your example.
Yeah, and I think Gaurav has made a question there, and it is a very, very common one we get. What happens when you come back to Australia? And the accumulated capital gains is basically taxed at that higher tax rate. So even if you do move overseas, come back, and then sell when you come back to Australia, the accumulated capital gains when you're a non-resident is always taxed at that non-resident tax rate. So it is a really important point. So in terms of this work example, and it is useful to use a work example here, there's a good point about assets purchased before 2012. It's still the accumulated capital gains whilst you're a non-resident is taxed. It doesn't matter when you actually originally purchased that asset. The accumulated gains from when you're a non-resident. So you draw a line in the sand from when you leave Australia. The gains from there forward are taxable at that non-resident tax rate. So you need to look at it sort of pre and post departure. And then when you come back, you then move back to the Australian tax rates, and it's all assessed depending on your length of stay and when you're a non-resident and a resident. So using this example, just to show you the impact of these taxes and what Ashley was mentioning before. So a property investor, and this is focusing firstly on a resident for Australian tax purposes. A property investor that buys a property for $750,000 and then sells it for $1.5 million, and for the full length of stay was a tax resident of Australia. They would get the 50% discount because they've owned the asset for more than 12 months. So that $750,000 gain, instead of it being $750,000 that's assessed, you halve that gain and you're only taxed on $375,000. So essentially the rate of tax for this person would be between $146,000 to $176,000, just depending on the other income, because all of that gain will go on their assessable return. So, depending on what their other income is like in Australia, it's between $146,000 and $176,000 that they'll pay. So the highest possible marginal tax rate will be 23.5% on the full gain, which is essentially half the 47%, which is the highest tax rate for an Australian tax resident. So, if Gina Reinhardt owns a property in Cottesloe in Perth and makes a huge capital gain and owns an asset for more than 12 months, she will pay the maximum rate of 23.5%. Now, contrast that to an Australian living overseas that buys an investment property and they sell it in 10 years' time, make a $750,000 gain. Australia will want to tax you on that full gain at expat tax rates, which is basically you start at 32.5%, so already more than what the highest rate is for a resident, and up to 45% is the maximum. So the effective amount of tax that you would pay in that scenario, if you're a non-resident for the full period of time, is $317,000 to $337,000. So very significant difference between residents and non-residents. And sorry, this is continuing longer than we thought. Really sorry about this, everyone. It's hopefully going to stop soon, but very, very frustrating. But a contrast to this is that the way Australian shares would be treated. So if you buy the shares whilst you're overseas for Australian tax purposes, the maximum that you would pay, firstly, looking at the for a resident for Australian tax purposes, exact same tax outcome as if you were to own property or shares. You pay that same rate of tax. There's no distinction between the two. If you're a non-resident for Australian tax purposes, for the full time of ownership, you will not pay any capital gains tax in Australia. You will be assessable if you sell the assets whilst you're a tax resident of the US. So between 15 and 20% is usually the tax rate if you sell the assets in the US. There are scenarios where if you're on an E3 visa or going over to overseas and you're not a long-term green card holder or not a citizen when you come back to Australia, there is a scenario where you could actually not pay tax in Australia. And because the US doesn't deem disposal of your shares when you leave the US, unless you meet, you're a long-term green card holder or a citizen, there is a scenario where you won't owe tax to the US either. But get professional advice around that because it is complex and you want to make sure you're doing the right thing there. But it can be really a big opportunity for Australians to actually build shares whilst they're overseas and manage funds. So John, really important one. Yep.
What I was thinking is perhaps I could go to my section towards the end, put you on mute, and then we can come back to this primary residence in Australia.
Oh, yeah. Hopefully it's gone by then.
Yeah. That's, thank you for your patience with that. US immigration status. Okay, so this is what I wanted to come to in talking about the considerations that you need to make before moving to the US. Now, this is really not going to be relevant to US citizens. So if you're a dual citizen or an American citizen at all, and you're in Australia, you're thinking about this, it still could be relevant, but it's a much bigger decision, and we're not going into that today. And that would be the topic of relinquishing your citizenship. So we're not going there. But why does making the right immigration choice matter? It matters because it has tax impact to you, or it could have if you become what's called a long-term US resident. And this happens when you become a green card holder. It starts the clock on this particular rule where you're deemed a long-term US resident if you've been in the US for 8 of the past 15 years. And so if you're surrendering your green card or you're a US citizen relinquishing citizenship, and you meet one of these 3 tests, the 3 tests being the annual average net income tax liability, it's pretty high. Do keep in mind, so in 2020, it was $171,000. Let's be clear, this is not your income. This is your income tax, your federal income tax. So we ran the numbers on this, and depending on your tax filing status, it's somewhere between $600,000 and $800,000 of income. So you're going to be making a pretty decent income for this first test to apply. The next test is the low-hanging branch that gets most people because it's not inflation indexed. If you have a global, underline bold that word, global net worth of more than $2 million, which if you own a home in one of the major metro cities of Australia or the US, that's going to be a pretty significant number right there. Throw in your retirement accounts in Australia and the US, throw in some brokerage accounts, maybe some stock options or RSUs, and it's very easy to see a global net worth in excess of that. So that second one catches a lot of folks. And then the third one is one that we would really see a client want to take care of before we even get to this point, and that is making sure that they're compliant and current on all their state and federal tax obligations, and can sign an affidavit to that effect, saying that they're compliant for the preceding 5-year period. So if the individual does meet is a citizen or a green card holder, does meet one of those 3 tests, they're deemed a covered expat and possibly subject to an exit tax. And we've done a webinar on that. We'll go into the 4 different types of taxation, the 5 different types of tax asset classes that are taxed in that situation and how that works. So I would refer you to that webinar. So what are the other choices that you might consider? A lot of folks will find that going down the green card road is appropriate because of the administrative inconvenience and the bureaucracy of getting visas renewed. That can be very troublesome and very problematic. I had a client just last year, as a matter of fact, was unable to get his E3, excuse me, let me reconsider. It must have been 2020, was unable to get his E3 extended. So this is 2 years ago, due to COVID, due to the slowdown that was happening in these immigration offices. And he had to come back to Australia. He had to sit in quarantine for 2 weeks. And then another couple of days after quarantine, he was finally processed and he could come back. So absolutely a massive disruption to his life to have to do that. So there's an example of where proceeding with a green card, knowing full well that he is likely to stay beyond that 7-year period to assume 8 of the past 15, he's still choosing to do that. And we see that a lot with folks that work in the tech sector. And really there's a trifecta of good news for folks in the tech sector work in the US. That is, they tend to make 25 to 30% higher incomes in nominal terms. They enjoy the US tax rates, which tend to be low, not always lower, but mostly lower. The tax status is better. And so they can enjoy those 3 things and make a lot of money and still be fine with paying an exit tax, because the overall net, the accretion in net equity that they make is better than if they move back to Australia, made less money in nominal dollars, made it in Australian dollars, which, as we know, we're sitting at 71.5 cents today. So there's a significant discount right there. Lose their filing status and pay those higher rates. So that often is advantageous for folks in the tech sector. So other non-immigrant visa options include the E3, E2 for business investors. That's getting a little bit more avant-garde right there. H1B visas, L1s, O1s. These are other alternatives, and that's my point in raising your awareness to them. So what are some other basic strategies one might think about before this is not so much before obtaining a green card, this is before obtaining US tax residency. The point here would be to accelerate non-US source income where your tax rate in the US is going to be higher, or when your tax rate in the US is going to be higher. That is really going to be the case if you're moving to a state with a state income tax and you're talking about a fairly large income recognition event. So if you're going to be paid $1 million, let's say, and you're coming from Australia, moving to California, let's do a quick comparison. $1 million Australian dollars, let's call it just for ease of comparison, 700,000 US, assuming in my hypothetical example that the individual is married. Let's go over here to never leave home without my handy dandy key financial data sheet. So if someone is going to be paid 700,000 US dollars, and this is in addition to whatever their normal income is, so they're being paid 700,000, that's putting them in a 37% federal bracket. And they're in a state of California. Then now let's add these two together, 37 plus 12.3. So we're up to 49.3. Let's not forget about the net investment income tax. So there's a bonus 3.8% tax right there. You're now in a greater than 50% marginal rate. And so depending on the situation, it may in fact make sense to accelerate that income prior to becoming a US tax resident in a state with a state income tax. Conversely, we may see the opposite. We may see for US sourced income, so this would be in an example where, say, someone owns a house, an investment property perhaps in the US, they may decide to accelerate or decelerate that US source income subject to the 0% withholding rates as a non-resident alien. And that's a key concept there. That's the charming term that the US uses to describe those that don't have any legal status in the US, the non-resident alien. The tax treaty between Australia and the US provides for 0% withholding. And so that does present an opportunity. This is more on the outbound situation than inbound, but it is conceivable that you could see it on the inbound as well. This is where we come back with two strategies. John alluded to one of them earlier. So one of them would be to do with capital gain assets. Another would be to do with retirement accounts. If you're moving back to Australia, you don't hold any incidence of US legal or tax status. You come back to Australia, you effectively surrender your green card. You're not a long-term resident. You're not a covered expat, or even better than that, you were in the US on an E3, H1, O1, L1. You get essentially a step up in basis for those assets, for those capital assets that you purchased while abroad. And for the retirement account, that gets distributed as per the treaty file, your W8 BEN, claim your 0% withholding rate, and you're able to get that retirement account back, which is a wonderful outcome. Okay, moving on. So here's another thing, because today's presentation is really focused on inbound strategies. I mentioned this in the last two presentations to do with stock awards. Some of these are general principles that we need to keep reminding ourselves of. The tax basis of an existing asset. So what does this mean? It means the point at which an asset will begin being taxed from, let's say. So Australia takes the view, as you heard me say a moment ago, that you get taxed on an asset, assuming you acquired it overseas. It's a different story, and I'll let John clarify that one when he comes back online. But if you return to Australia and you've acquired an asset abroad, they say, welcome back, thank you very much. I see you now own stock, low basis stock in this company. That's fantastic. We don't really know what you bought it for. We're going to say the basis of that asset is the fair market value on the date you resume Australian tax residency. What does the US say? They say, no, we don't think of it that way at all. We want to know the original purchase price. And so if you acquired a low basis asset in Australia, then you moved to the US and sold that asset, the Americans don't say, oh, well, you moved here years later after you acquired that asset. We're gonna tax it as of the date of what it was worth when you moved here. No. They're going to say, we want to know what you bought it for long before you ever considered moving to the US. We want that original purchase price. So that has important implications. And I wanted to mention this earlier with a point John made, and that is John's very first point was to do with get started early with your planning. And let me be specific with how early. And I will admit, it is a little ridiculous. It does make it very difficult. But the US has a 5-year look back on transfers that are made. So if you're planning to move to the US, 5 years would be the magic number before you're able to retitle or sell to a related party, being mindful of other tax rules that might take a dim view of such a transaction. You want to be taking those moves 5 years beforehand, because there is that 5-year look back to be mindful of. So how to get a fresh basis step up? This is a little bit more sophisticated financial planning. I'd say that applies to higher net worth individuals dealing with businesses or real estate in particular. And the reason I say this is it's a 7-figure sum kind of tax strategy. And that is, you can go and start a corporation in the British Virgin Islands or Nevis, take a check the box election, transfer your asset into that company. Now, there may be Australian tax implications for that. That's another matter there that I won't get into. But for the US perspective, this is a strategy that does allow you to get a step up in basis. So a little bit more involved, and that would be one to talk to a tax attorney on. And a very important concept here, John was talking earlier about ETFs and managed funds in Australia. If you move to the US, that is going to be bad news. You want to be taking your Australian resident tax rate advantage while you're still in Australia to reconstitute your portfolio. And what does that mean in English? What that means is we do not want to hold Australian domiciled ETFs or managed funds. There is an exemption for super. So if your employer has contributed the majority of what's in your super account, you haven't made a whole bunch of trades, and it will be deemed that you don't have a great degree of control over that account, very likely to be given the employee benefits trust tax treatment, in which case that's exempt, so we don't need to worry about that. If you have a self-managed super fund, I'm sorry that there's no exemption for that. That's bad news as well. It's going to be deemed a PFIC. Now, why are PFICs so unpleasant? The default treatment, the Section 1291 in the Internal Revenue Code treatment for them is they're charged at the highest marginal rate for every year you held the PFIC. Now, that's not your highest marginal rate, that's the highest marginal rate. So presently 37% and previously 39.6%. So very, very difficult, very burdensome. The other way in which they're burdensome is actually simply completing this Form 8621. The form itself is a nightmare and takes many, many hours to complete. So bottom line here is, as you move to the US, be mindful of what you hold that might be considered a PFIC. Now, John and I, we would see this every day, ETFs, managed funds. That's not the full list of things that might be considered PFICs. You've got hedge funds, private equity investments, cash value insurance product, foreign businesses, that again, it's more obscure. We do get into that with high net worth individuals, but businesses can be caught. Rental properties, if they're held inside of some sort of corporate entity, can be caught. It's all bad news. So what can you do? How do you get out from under this? There's a couple of ways, one of which would be the qualifying electing fund method. I don't actually, it's funny because this is on the books that this exists, and there's a couple financial planning strategies that John and I are aware of that exist on the books. They just don't exist in reality. So I've never actually heard of a qualifying electing fund that Australia offers. And Canada has a bunch of them, but not Australia that I'm aware of, or I've ever heard of, or I've ever found. And that's essentially a managed fund where they have complied with the US tax reporting laws, and the US says, yes, this satisfies the way we think of managed funds and how they should be taxed. Like I said, I've never heard of it before. So getting back to the land of reality, how can you do it? How can you have a portfolio that is PFIC compliant? The way to do it is with what's called an SMA, a separately managed account. And that's essentially, as this diagram here is showing, we don't want this folder box full of individual files, which is your mutual fund. We want the individual files, like the individual stocks themselves. And the difference here is, it comes back to the definition of what is a PFIC, and there's two tests there that are relevant. We don't need to get into that. But the thing is that if you're owning individual shares, they don't pass that they don't meet that test. So if you own shares of Telstra, not that I'm recommending Telstra to anyone, but if you own shares of Telstra, they're not an investment company. They're not deriving the majority of their return through passive income sources, dividends, rents, interest, etc. They're making a profit from running a business, and that's what allows it to be PFIC safe. John, we're going to pass it back to you. Where are we? Primary residence. Hopefully that fire alarm has stopped by now.
Just gone, Ash. Which we tested it out. It's definitely working. We tested it for 25 minutes. Sorry to everyone for that. It's definitely didn't think that was coming. But so a really important point is your former primary residence, and this was a recent change that happened in 2020 that the Australian government brought in, and it has made it, unfortunately, for anyone selling their primary residence whilst they're overseas, a taxable event. So for an Australian tax resident, as most of you would know, if you're an Australian tax resident for the full ownership of your property, you will not pay capital gains tax at all, regardless of how much it goes up. You could buy a property for $2 million and it goes up to $5 million, that's great. You will not pay capital gains tax when you're a tax resident for Australian tax purposes for the full period of ownership of the property. Now, you can actually move out of Australia, move out of the primary residence for up to 6 years. There's a thing called the 6-year rule, where you can move out and the property becomes, you can still treat the property as your primary place of residence for up to 6 years whilst you're a tax resident of Australia. However, if you buy your primary residence, move overseas, and then sell it whilst you're a non-resident for Australian taxes, basically you will be taxed for the gains that even the gains from when you were a resident for Australian taxes on the primary residence. You lose that tax-free exemption. Now, the tax on investment properties and the loss of the 50% discount started in 2012. So you still lose that 50% discount as well. But that's the key point now, is that you would lose that tax-free status if you sell it whilst you're overseas. Now, if you move back to Australia and then sell it when you're a tax resident of Australia again, then you would retain that tax-free status as long as you're within that 6-year rule. So the key point is that you, as much as possible, avoid selling your primary residence when you're a non-resident for Australian taxes. Now, the key thing to look at is if you're moving overseas and you're unsure if you're going to come back to Australia, it may make sense for you to sell, the primary residence before you leave. You want to be very, very... Sorry,
John, I just wanted to add a point in there, and that is that American tax residents, American citizens or permanent residents, need to be mindful that they only get a $250,000 for single or $500,000 for marriage filing joint exemption on the primary residence. So John's example of the $2 million property that goes to $5 million, this is where clever planning comes in. If you're a mixed nationality couple where one is not a US tax resident, then what do you think the smart thing to do would be to do with the titling of the house? Get the American off the title. Of course, it's maybe not as simple as that, possibly other tax implications there, but I just wanted to mention that thing.
No, it's an excellent point as well, Ash, as well. And that's where it is important that, the professionals you're speaking with actually understand Australian and US taxes, because that's a common thing we'll look at with our clients, is that, for anyone that does have, a partner that's not in the US tax system, then you will look at assets like the PFIX that Ash was talking about and the primary residence, because the US doesn't have a blanket exemption on capital gains on the primary residence like Australia does. So there's ways that you can navigate both systems by some clever planning, as Ash puts it. But the big thing is that, and I've seen it in many examples where, an Aussie will, assume, or think they're going to come back to Australia, but, work, they get promoted overseas, or, their kids start going to school, or they meet someone in America. So just maybe think about that before you leave. You want to be really sure you're going to come back to Australia if you've got a former primary residence that's, got an assessable gain, and you're looking to sell at some point, because the tax can be quite horrible. So moving on just to the next slide. So family trusts are really, it's an important area to look at if you're moving from Australia to the US. So family trust, just to introduce it very quickly to those that aren't aware, they're a planning tool in Australia and work reasonably well for some in Australia in terms of tax planning and estate planning and asset protection. So the way they work when you're a resident for Australian tax purposes is that, and you're not paying US taxes, is that essentially you hold the assets within a family trust, and you can distribute the earnings or the capital gains to anyone that's listed as a beneficiary, usually, your broader family group, you can determine who gets the income or the capital gain marked against their personal income tax return. And you have a lot of flexibility and determine who's the most appropriate person to receive it, and really try and minimize taxes from an Australian tax planning perspective. That works really well when you're a resident for Australian tax purposes, and can be an effective tool. But when you go over to the US, or become a non-resident for Australian tax purposes, like many of these Australian financial planning considerations and strategies, they don't work as well, unfortunately. So, there's a few considerations on how Australia treats the family trusts for tax purposes, how the US will treat the family trusts, which I'll go through in a second, and then just whether it is effective for your estate planning. So just going on to the next slide here. The way it's taxed as a non-resident for Australian tax purposes is that the trustee of the family trust will pay the taxes on your behalf if you're a non-resident recipient of a distribution from a family trust. The big point is that when you receive a distribution as a non-resident for a family trust, and assuming that this is a share portfolio and there's been a capital gain that's been distributed to you. Now, the Australian government will want to tax that as taxable Australian property. And this has been a recent change that is through case law that's come through the Australian courts in the last couple of years, that has sort of been a little bit confusing and a little bit surprising to many in the advice and tax community. Is that usually when there's a distribution from a family trust, it gets taxed in an individual's name, in their, as they would be taxed if they own the asset personally. However, if it's a distribution from a family trust and you're a non-resident, then Australia will want to tax those shares. Whereas if you own those shares personally as a non-resident, as we mentioned before, you would not be taxed. So I guess there's consideration here of whether those assets are actually, or whether the assets that are owned within your family trust are better positioned in your personal name, or whether they're better actually positioned in the family trust, where Australia will want to tax the assets. The ATO has made it very clear they want to tax any distribution from an Australian resident family trust, regardless of if you're in Australia or overseas, and regardless of the treatment of shares and managed funds, if they're taxed in, or how they would be taxed if they were owned personally in your name. So there's some planning to do there before you leave the US and just whether you should be receiving a distribution or not. Now, how the US looks at an Australian family trust, if you commence the family trust and if you contributed the capital to the family trust, that is an effective way for some that are on higher tax brackets to shield the earnings from their assets in Australia. Unfortunately, it typically won't work in the US, because the US will essentially look through a family trust that you've commenced and contributed the capital to and say, well, that's a trust, or that's basically investment in your name, essentially. That's a foreign grantor trust, as they put it, and basically look through that structure and just tax the assets as your personal earnings in your name. So it won't have the same tax planning opportunities, unfortunately, when you go over to the US. So you've really got to rethink these structures and determine whether they work. They worked potentially as when you're a resident for Australian tax, but will they work when you become a non-resident? And will they work on the US tax side of things? Which leads me on to superannuation, which is a classic grey area for US taxes. Ashley alluded to a couple of treatments earlier, but the thing I'll mention, just firstly, you've got to think about your retirement planning. If you're leaving Australia and moving to the US, you've always got to think about how you're going to build for retirement and build the resources that you'll need for retirement. There's various ways you can do that, and there is a temptation for many to put money into superannuation, because it is an amazing tax vehicle, as we know. We're very lucky in Australia to have superannuation. However, it is a really grey area for US tax. The IRS have never come out and said this is exactly how we treat superannuation for US tax purposes. So, but the way the most US accountants will treat it, as Ashley mentioned, is that if the superannuation is more so what your employers contributed rather than you putting in these big lump sums into your personal super fund, then it'll be an employee benefits trust. Self-managed super funds for US tax purposes. Now, every accountant, tax lawyer I've seen would treat it as what they call a foreign grantor trust, where, as I was mentioning before, they would look through that structure and say, well, that's not a retirement vehicle your employer's set up. It's kind of more of an investment vehicle that you've set up. And we're going to look through that structure and basically tax everything in your name and on your personal tax return, rather than defer the tax until your retirement. Now, the big point there, which I've mentioned before, beware PFIC, which is what Ashley mentioned. So usually there is an exemption when you own, because most people in their industry or retail funds will just have managed funds. Usually there's an exemption for that, and the US won't be too worried about it. But when it is a self-managed super funds and you do own managed funds or ETFs or other PFIC, passive foreign investment company assets that Ashley was mentioning before, then that becomes an issue. And because the US is really looking at this self-managed super fund as essentially your asset, they will look at that and potentially apply those higher tax treatments, as Ashley was mentioning before. And it is quite onerous. And the key point, which is the bottom point there, is that it will add, definitely more complexity to your US filing, extra cost, and probably, extra tax as well. So that's the US side of things. Now, looking at the Australian side of things, and just generally when you become a non-resident for Australian tax purposes, big considerations around this. So if we just move on to that next slide. So anytime you own a self-managed super fund, you've got to ensure that your fund is complying or retains its compliance status with the ATO. And there's some key points and rules that you need to meet to make sure that your fund remains compliant with the ATO. The first one is that initial contribution and the investments need to be domiciled in Australia in terms of the initial contribution to set up the self-managed super fund. The next two are where expats can land in trouble. And it's the active management and control of the self-managed super fund needs to be from Australia. And any member of a self-managed super fund needs to be a trustee, and ultimately the trustee has control of the self-managed super fund. You are in charge of the decision-making and the administration of the self-managed super fund as the trustee. So you've got to be, and that by the laws of the ATO needs to be domiciled out of Australia. Now, there is a bit of a grace period that they do give people moving overseas, which is 2 years. And the key word is that if you intend to reside temporarily, and the key word is temporarily, for 2 years, then it's okay. So if you're moving over to the US for 12 months and you intend to come back, then you typically will find you're okay under this rule. But the key word is temporarily. So if you're looking to move overseas permanently, obviously permanently, is greater than 2 years. That there's no 2 year rule. That from the day you move overseas, the ATO will say, you're potentially in breach of this because you've moved overseas with the permanent intention of going overseas. There is talk about increasing the length of this, and it was proposed in the last budget, but we are, it hasn't gone through Parliament as yet, and we're in an election at the moment in Australia. So whether that will change or not is not sure at the moment. But the last one you need to meet is that the active member, so the people that are contributing into the fund, have to own at least 50% of the assets or 50% of the contributions going in. So that's another key point that you need to meet. If you're non-complying by the ATO, so if you don't meet any of these rules, the tax goes up to 45% of the income and assets. as opposed to the usual 15% maximum tax rate that there is within superannuation. And there is an immediate tax potentially of 45% of the capital of the fund. So it can be a very, very, very significant tax that you pay if you don't comply. So I guess before leaving Australia, and again, it goes back to that point, you've got to really think about what assets you hold before you leave Australia. Consider whether the self-managed super fund is appropriate for you, and whether you should have the self-managed super fund or not, or whether you look at a more traditional super fund like a retail or industry fund. There are things called small APRA funds, which are, I think we term that as the unicorn of Australian super funds. I've never actually seen one, but they do exist apparently. They may get around some of these issues, but you certainly need to consider how the self-managed super fund, it may have been appropriate when you're a resident for Australian tax purposes. How's it going to work for the US? How's it going to work when you're a non-resident for Australian tax purposes? It may be very, very different. So I think that's basically it for our presentation, Ash.
Yeah, I think that's right, actually. So that brings us down to the questions. Actually, hold on. Yes, where are we? Before we go to questions, where do you go to learn more? John, how would someone make contact with you if they felt that your services were appropriate?
Yeah, so the best way, we've got a dedicated US Australian section of our website, and there is a section that you can make an inquiry. So if you go to www.aptwealth.com.au and you go to our dedicated, thanks Ash, if you're bringing up there. So if you go to Expat Services, and then there's the US Australian expats, there's a lot of resources here, and you can go to the contact us and make an inquiry if you'd like to have a chat. And that would be the best way of getting in contact with us.
And to get in contact with me and to make an appointment, I would encourage you to come here to get started. Orient yourself to how you know if you're a good fit for who we work with. That's the process that we follow, and then you can go ahead and schedule a time, and we can connect as appropriate. Let me see. We've also got a Q Financial data sheet available on our website, which leads us to questions. So let's start at the top. There was a question from Dean with regards to the status of if the Labor government comes into power. John, have you heard anything about them proceeding with the Liberal proposal for redefining the Australian residency definition?
Yeah, and thanks for the question, Dean. It is at the moment, there's no, I haven't heard anything from the Labor side of whether they would proceed with the changes to the tax residency laws. And even actually, there is a lot of pressure from various groups on the coalition side to potentially rethink some of the rules. I mean, as I mentioned, it's a convoluted test that was set up years and years and years ago before there was the international mobility. I think it was the 1930s or 20s that actually wrote the laws around tax residency in Australia, well before the world as we know it today. So it's out of date. It needs to be updated, but there is conjecture around that 45-day rule that you mentioned, Dean. So at the moment, the ruling was it had to come in before the end of the financial year. So because we won't have Parliament sitting before 1 July this year, it's 99% sure that it won't come in time for the next financial year. And it hasn't actually even been tabled in Parliament as yet. It hasn't entered Parliament. So what happens with this change in tax residency, if it comes in on either side, is really up in the air. And it's frustrating for many Aussies overseas because you need clarity and you need certainty on how you're going to be taxed. But there's a lot of proposals on the table and a lot of uncertainty of what the actual legislation will be, if it actually changes at all. So hopefully that answers your question, Dean. But in short, there's been nothing that we've seen in terms of Albanese or Labor on what their position is on this legislation, because it hasn't really been a mainstream consideration, and it hasn't entered Parliament as yet. Hasn't been mainstream from just the standard Australian political landscape, I should say.
John, there's a question here. I think I can lump together Garab's question, Ben Waugh's question, also Jen Wilkes possibly as well. I think what we need is a good visual description, and maybe you know of such a source, where we could talk about how capital gains works for a property purchased, and maybe even two scenarios. You'd have to say pre-2012, how does that work? Post-2012, where an individual enjoys some portion of gain while they're still in Australia, continues to grow while it's overseas, and then grows when they return back to Australia. Maybe you could walk us through that.
Yeah, no, and it is confusing, and that's a very common question we get. Now, there was a significant change on the primary residence that I mentioned a couple of years ago, but there was a very significant change back in 2012, where the 50% discount on capital gains for investment properties in Australia, when you're a non-resident for Australian tax purposes, was disregarded. So I guess you've got to look at it as so basically the first point is that anything that was owned or any gains that were accumulated before that date in 2012, you get the 50% discount. Any gains that were accumulated between 2012 until you were a tax resident, you get the 50% discount because you're a tax resident. Any gains whilst that were attributed when you're overseas, you do not get a 50% discount. Any gains that, when you come back to Australia, you get the 50% discount. So you've got to look at it basically every step for the gains attributed in those each of those periods. That's how they'll be taxed. So essentially, you've got to look at it as, and it can be difficult, and this is where the complexity lies, is that for people that had an investment property and bought it in the year 2000, to know what your primary or what the investment property was valued in 2012 is very, very difficult, and that's where a good accountant will come in and work through some different methods that they've got. But that is essentially how it works, is that the portion of the gain before that change came into force, there's a 50% discount, but anything from 2012, anything from when you've been a non-resident, you will not get the 50% discount, even if you come back and sell it in Australia. So the portion of time that you're a non-resident, the gains in that time, you do not get a 50% discount. And it's a pretty complex calculation, essentially, to work out your eventual tax. Hopefully that answers the series of questions there.
Very good, very good. Jen Wilkes has got a question. I'll do my best to answer this one, Jen, because I recently looked at this in some detail. Jen asks, I've also heard that as a US tax resident, you could also be up for federal and state taxes in the US if you sell taxable Australian property while a US tax resident, in addition to the non-resident Australian tax, and that CGT is not covered under the double tax treaty, which only covers US federal tax, not state taxes too. There's a lot in that question. And the first thing I wanted to say there, and John I can almost guarantee you would agree with me on this point, is that this is a fantastic example of where, due to the lack of laws that clearly specify how these kinds of situations would be taxed, we have to work our way through them, essentially using our best judgment, and this is one, and conservative judgment to that end. It's one where really a cross-border CPA is best consulted with on this answer. However, as I mentioned, I did look at this recently with a cross-border CPA, and the answer is basically it's highly subjective. But let's break this down. So you could also be up for federal and state taxes in the US if you sell taxable Australian property. That we didn't know. That was something where the cross-border attorney said, cross-border CPA said, we would need to do a research project into that to see if in fact you would get a US tax credit, a foreign tax credit for that Australian tax paid on that property. Hopefully, yes. So while a US tax resident, in addition to non-resident Australian tax. So that's true. If it's taxable Australian property, it's going to be Australian sourced. Australia gets the first dibs at taxing that. And if there's any additional tax owed, probably at the US state level, where they're not inclined to recognize foreign tax credits, then you're likely to have a US state tax obligation as well. John, did you have something further to add there?
No, sorry, I didn't mean to, to raise my hand. That is very true, and a lot of this, unfortunately, because the double tax treaty is sort of internationally known as not being, or being one of the poorer double tax treaties out there. That there are some significant grey areas, and it is important, to get some advice around any sort of major asset disposal.
Okay. Carl's question here. So I typed in and addressed his testamentary trust. It's really no, that comes into effect at death. So that's not quite the same thing. Are houses, apartments that are inherited and then sold within around 12 months after inheritance considered by the US to have been acquired at the time of inheritance and therefore have 12 months of capital gains? I don't know. That's just one of those things that's so specific. I'm not a CPA, couldn't answer that. I'd be inclined to say the basis would resume at the fair market value at the date of death. That's what would make sense to me, but see a CPA on that one. And that looks to be about it. Paul Trainer's got a comment here. But other than that, I want to thank everyone for coming here today. This has been a well-attended, very interactive, and hopefully you found informative webinar. And I also wanted to thank John Versace of Apt Wealth Partners for providing the Australian perspective here.
No, thanks for having me, Ash, and it's great to be joining you all. And sorry for the disturbance, but hopefully you could hear me through that, and you got some good insights into some of the considerations as you make the journey from Australia to the US. And I guess, look, I've had a lot of clients as well that have come to me before they go into the US and kind of put it all into the too hard basket and say, oh, it's too complex. It isn't. You can do it. There's ways around to navigate these things. Unfortunately, you've got to tread carefully, but you can structure your assets in a certain way, navigating non-resident Australian tax and US tax, and still build your wealth. And Ashley and I help a lot of clients do that. But you've just got to just navigate some things that unfortunately it's a little bit more difficult than just a straight Australian tax resident or a straight, US tax resident.
Very good. All right. Thanks, everyone. We'll see you next month. Thank you, Jen. All right.
Thanks very much. Thanks, guys. Bye.